Let's get started. Welcome to our webinar, and thank you for taking the time out of your day to join us. We're happy to partner again with one of our most popular speakers to bring you this webinar today on option strategies and technical analysis part 2. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, InvestTrade. A few housekeeping matters before we start. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar, and our speaker will answer those at the end of his presentation. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer options trading, and we enjoy teaching people how to trade them. We offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform as well as free trading tools to help you spot option trading opportunities. Our parent company, Regal Securities, has been servicing investors since 1976. Also, a recording of this video will be available on eOption's YouTube channel, along with an extensive library of trading videos. So we encourage you to take a moment and subscribe today to our YouTube channel. And as we said, this is part 2. Part 1 was last month. So if you'd like to see that, you can also find that on our YouTube channel, as well as on eOption's website. So before we start our presentation, I'd like to walk you through our disclaimer, as you'll see on the screen. Options trading does have risks. And if you go down to the last bullet point, you'll see options carry a high level of risk and are not suitable for all investors. And there is a booklet called Characteristics and Risks of Standardized Options that you can get and that everyone is encouraged to read before they start trading options. So you can feel free to send an email to us, support@eoption.com, and we're happy to send you a copy of that booklet so you can read it at your convenience. But I'd like to turn our attention to our speaker now, Teddy Kekstadt. He's done many webinars for us, and we'd like to welcome him back today. Teddy is a professional trader and has over 30 years of trading experience. He traded on the Chicago Board Options Exchange, the Chicago Mercantile Exchange, and the Chicago Board of Trade for 21 years, and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked and is the author of the book, High Probable Japanese Candlestick Patterns. He also has a degree in finance from DePaul University. So without further ado, I'll turn it over to Teddy Kekstadt. Thank you.
Thank you, Gina, and everybody else for joining us today for our webinar. And we have a lot of ground to cover. So, and especially since now it's springtime, it's a lot harder to keep people indoors. So we really appreciate your time today. So we have the eOption trading platform up for you here. It is the paper trading, not a real account. So, but it's very similar to the regular platform. We're going to be using a couple different spots on it. We're going to be using the trading option. Obviously, we have the account summary here, which shows you where your balance is and what you have available to trade for both stocks and options. We have some expired contracts here from our last webinar that were executed, and now we actually have a flat balance. So as you can see, starting the day here with our webinar, we have no transactions, so we have a clean slate for what we're going to be pulling up today. All right, so we're going to pull up the trading icon. Now, besides the trading icon, there's all kinds of things you can use here that you can get help from, support from eOption. They have a daily outlook, they have different screeners, they have options play, and then they have positions and orders, obviously, for when you have existing trades going on. They have a research tab. So there's all kinds of different things that you can use to help you along your trading journey with eOption. Okay, so we're going to be talking about technical analysis and how to apply certain positions in the marketplace, depending on whether you have a buy or a sell signal, a different type of trading pattern, and different type of technical analysis ways of reading the market and figuring out whether you're buying or selling. So we're going to use puts and calls. When you're looking for long trades, we obviously will be using calls. Remember, a call is right to buy the underlying market. We'll be using credit spreads on both the bullish and bearish side, and also straddles, which is where you simultaneously buy a put and a call, the same strike price and also the same expiration. And we'll explain, especially like with credit spreads, when you're close to expiration, why you sometimes may want to use those versus others, and also depending on their pricing and things like that. So, all right, so now let us get to the, all right, let's pull up. We have PZT. Now, PZT here is a stock that has a piercing line buy signal that has been it occurred yesterday. Now, what is a piercing line buy signal? Well, a piercing line buy signal is a high probable Japanese candlestick pattern that when it occurs, especially in a situation like this where the market has been breaking down, this is a good indication that not necessarily that the bear trend is going to stop, but at least in the short run, you're going to have a corrective move. So in this type of situation, we also look at the indicators. Now, it's both below the 50-day and the 200-day moving average, which have kind of leveled out here. So that means the trend is becoming neutral, even though the short-term trend in price action is obviously bearish and lower. We have the MAC moving average convergence divergence indicator, say that 10 times real quickly, which right now, as you can see, is starting to show that the market is a little bit oversold. It hasn't crossed to give us a buy signal. But remember, indicators such as this are typically lagging. So the piercing line, however, is something that has just occurred. So let's take a look at the PZT on the trading platform. So we have PZT for a stock. We pull up, we see if we had 100 shares. If we wanted to buy this right now, we could see that we could buy it somewhere around $22 and change. So since we have a buy signal, what will we do here? Well, if we're just an outright stock trader or even an options trader, now would be a good time to potentially, especially if you like this, the fundamentals besides the technicals for the stock, this would be a good buying area for the market. Now, obviously, the nice thing about when we have a signal like this, not always with technical indicators do you have risk levels that you can use. With this one, we do actually have a risk level. So when you have a pattern like this, where the market is breaking down, meaning trading lower, the low becomes your risk level or a little bit below it. So if you were to buy the stock right now, you can see that it's trading at, what is that? We said 22.23 on here. So that's right in between our bid and ask right there, 22.23. So this right now is where you could buy the stock, which would cost you just over $2,200 for 100 shares. Okay. Now, if you wanted to buy the call, and let's take a look at the pricing here. So we're trading at right around $22. Let's use the e-options trading platform, and we're going to go and find the options change for PZT. And this way we can see what kind of, how much distance there is to expiration. Now, since we're coming into June, it's very likely that we're coming into the expiration for some of these options, if not all of them, for June expiration. And okay, why is it not going in? Oh, here we go. Options chains. Come on, let's try and load this one more time. There we go. Okay, so symbol, put PZT again, and here we go. And we put all, and expiration, all, strike range, and for some reason I'm not getting the options chain proper on this. Okay, well, we don't need to have that, so we're just going to pull up the trade again. Sorry about that, folks, using the laptop today. All right, so since we have a buy signal, we're going to enter a buy to open call trade. This is what we're trying to do. Sorry about the little bit of a lag here. I think it's because we have the latency. Okay, we're having a little issue on this one. Okay, let me see if I switch here. Okay, so we have the 22. We're going to mark this down here, I'm sure. It's a 22 even strike price. Okay. So here is a call that is just a little bit below where we're trading right now in the market at 22.10. Okay, let's see if this loaded up now. Okay, so we want to buy to open. Quantity is correct. Sorry, folks, we're having a little issue here. I don't know why this is giving me this problem. Okay, well, forget that right now. Let's go and look what we're looking for. All right, so sorry about the delay on that one, folks. So we have a 22 even strike price. This would be a call level that we would be looking to purchase because of the buy signal. We'll get through this and then see if the latency picks back up. So the call strike price right here. Okay, so, and now since it's already the end of May, we would be looking for a July expiration. This would give us enough time to allot for some price movement. Now, how much price movement will we be looking for? So in this kind of situation, we take the last major swing high and we go down to this low and we look for the 50% level. Why the 50% level? 50% is usually a good area of where markets typically retrace to. So especially like if they're just a trend move, like for instance, now the market, it made this low, made a lower move high, it's been making lower move lows, we're trending lower, it's a short-term bear trend. This is a counter trend trade. So for a corrective level, this 22.59 to 22.71 area would be our target level for our options, okay? This would be the minimal. So for a call price here of 22, you'd be looking for this type of move minimally over probably sometime between now and would be the July expiration, which would be somewhere probably around July 19th. See this time frame right here for the market to travel higher. Okay, so now this would be if we just use an outright call. So that would be the 22 even call strike. Now let's see if we can pull this up. Once again, maybe if I just change the letter for a second. I'll go back to PZT. Okay. Let's see if I can just pull up a long straddle. Yeah, we have a little latency issue here. I think we forgot to set the speed on this one because we're not using the desktop again. Okay, so let's put the straddle on here. Okay, so for our straddle price, now we're going to do one call, and one put. Scrambling here today. So now this would be a 22 even strike, May or July expiration. And for the put, it's also a 22 even strike price and a July expiration. So when you do a straddle, now unlike just the regular call where we were looking for the market to go up, now remember we have a piercing line buy signal and the call at a 22 even strike price for July, that's where we're looking for this market to go up. But remember, this is a counter trend trade. What happens if we break down through this risk level? Now, if we own the stock outright, we could have a stop in, say at like $22 or something like that, or even $19.50 or something like that, with the amount of risk that we would be willing to take on this trade. Okay, now if we buy the call, we'll lose value. if we bought the stock and the market goes down, obviously we lose down to where our risk level would be if we have a stop in the market. So in those two scenarios, you can lose money. Now in the straight, if you have the call, obviously, and the market goes up, it's a profit. The straddle, however, if we use the same expiration, and when you use a straddle, we're looking for an immediate move. Now, since we have a current signal and it's a counter trend, we are looking for an immediate move. We're not looking for the market to grind around here and slowly build up. We're looking for the market to have now set a low and start to trade higher over the next week, week and a half, 2 weeks, up towards this target area up here. In which case, on the straddle, we would be making money on the call side, losing money on the put side. However, we would still be catching part of the move, and that's the main thing is that with the call, you have to be right on the direction. With the straddle, you don't have to be right on the direction. You just have to be right on the fact that the market is going to move right now. And since we have a counter trend signal, and this market has trended very, very low very quickly, if you look at the way it's been trading overall, then, and it also has the indicators are starting to show that it's oversold, this kind of goes in line with our signals for what we would want to do. So for this stock right here, because of this type of buy signal, we would like to enter a call with a 22 even or $22 strike price with a July expiration. That would be for just trading the outright buy. You could also just buy the outright stock, but then remember, you would want to have some sort of risk level. At least with the call, we know what our risk is. You're paying the price of the call. So let's see if we can get back to here. This is not loading properly. Okay, sorry about this. The platform is running slowly. It's because we're trying to stream too much stuff on too quick of a latency. That's the one thing we didn't reset. Okay, now let's see if I can get back to trading here. Let's see what happens. Okay, there we go. Yeah, that's still loading. Okay, so we're just going to go with the visuals on the charts. Okay, so for right now, we have that explanation for one buy signal. Now let's move on to the next one. All right, so now let's go to another stock called ATHM. Okay, so we have another bullish engulfing line buy signal here for ATHM. Okay, and for this one, the stock was trading at 29.77 yesterday when it settled, and I believe today it was actually trading right around the same price. So we're going to use the 29 even strike price for this one. So let's go here, put a little line in here and adjust this to 29 even. So for $29, that's the strike price that we're looking for this stock. The reason is we have this bullish engulfing line, this big green buy signal bar here. This is a buy signal called a bullish engulfing line buy signal. So we're going to use that as our base for this trade. So the 29 even strike price for the option here is just a little bit in the money. It's not at the money, it's actually in the money. So there's the market, that means the market is above the strike price. Okay. So we have one call with a $29 strike and a May expiration, or excuse me, a July expiration. Okay, so that here, this is the first trade that we have for this buy signal. Now also with this one, we would do the same thing with a straddle. But we're going to, before we do that one, let's actually calculate how far of a move we can expect here. So with this one, on the short-term basis, we pull this trade down here. We're looking for a move up to somewhere around here. Oops. set this to 30.99. Okay. And then we also have another one we're going to set up here at 31.52. Okay. So for our buying range here, we have a $29 strike price, and we're looking for the market to get just above 31 to almost 31.50 and change for at least a short-term move. Now the nice thing about this one is before we were fading the trend of the overall trend for the stock. This one, the market had been trading lower, but it recently had bottomed out, set this lower move high, a higher move low, a higher move high, and now this is a higher move low. So coming back into this has the potential to actually trade higher than just this initial target price, which is very interesting here. You see how the moving averages are coming in here? We have the smaller one, which is the 50, and then we have the 200, which is the larger one. So originally, this market's been falling off of the 200-day moving average. This time, however, if we can get it up into this target zone here, it'll be back above the 50, and then also has a chance to poke above this 200 again. So there's a nice little amount of room for profit on this, on the $29 strike price with the July. Stuck on the futures from earlier today. There we go. Okay, for the July expirations. Okay, so for the call and also for this for the stock right now, you're looking at a buy signal that has a very low risk, high reward probability for being bullish on this market right now. Now, does that mean overall the stock is a great investment? Absolutely not. We're looking at technical trades in the short run. We have, once again, this market on a price basis is starting to show a short-term bullish trend. If we get back above into this target area where we're looking for, that also confirms some strength. So that means there's a little bit of room for this trade. So if the market does get back above this $31 area, you don't necessarily have to just dump this option right away. That would be something where you might want to look at if the overall broad market starts to turn. Like right now, it's a little bit under pressure. If all of a sudden over the next week or so you see a big rally in the major indexes and you're also long this either the stock or the call, it would be a good area where maybe you either take some profit or you look to maybe extend it for a little bit because you have time. Okay, another trade here would also be the straddle, and we're also going to do a credit spread here also. So for the straddle, you would be buying one call, $29 strike, July expiration, and then we have one put, $29 strike with a July expiration as well. So that's one call, same strike price, same and July expiration, one put, same strike price, 29, and same expiration. So this is here is another directional or non-directional but movement play. Let me get this out of the way because it's taking up a little too much space. Now here's another trade you could do, which is a low risk trade, is to put on a credit spread. So that's would be where we use puts instead of using calls. So let's say you don't want to buy the stock and you don't want to take the time to really figure out if the market is going to get up into this target zone. Should you get out of your call? Should you get out of your straddle? Another thing you can do is play the June expiration. So we know that right now it's May. June expiration is coming within the next couple of weeks. So a credit spread is very, very good when you're close to expiration. So if you're within 45 days, especially, and now we're within 30 days, time value is gone from that option. So the credit that you get is pretty much locked in, and it defines your risk, because the only thing you can lose is the difference between the money you take in and the difference in strike prices of the one that you buy and the one that you sell, which we're going to talk about right now. So for a credit spread, okay, we would be selling the front month put, or the closest strike put. So we would be selling the $29 put with a June expiration. Remember, that's less than 45 days. And then we would be buying the $28 put with a June expiration. So even though you're writing an option here, you're also covering yourself with the buying an option. So what's the difference here? When you put on these other trades here, whether you buy the call or you buy the straddle, you're going to have to put up capital to put these trades on. In this case, you're still looking for the market to go up. Maybe it goes up to the target area, maybe it doesn't. The only thing that's important is that it's higher than it's where it's at now or higher come expiration. And that's why you're selling the $29 put. That's the more expensive put because it's closer to the market. And you'd be buying the $28 put, which is down below here, near where the lows were. So in that case, your only risk is between 29 and 28 minus the credit that you take in, because when you sell the $29 put, you're getting more money than you're paying for the $28 put. So that credit that is subtracted from your risk, because the only risk you have is if the market goes down below $29. And if it goes below $28, well, you're locked in. You can't lose any more than you would anywhere between the difference of, once again, the credit you took in and the amount of money that is between those two strike prices. So you have a $1 gap, which is $100 of risk, okay, for the option. So that would be the only thing that you have to worry about as far as risk, and it's defined. So even though you sold one put, you bought the other one that covers it. So if the market gets down to say $20, okay, you lose the same amount of money as if it went down to $28, okay, because your $28 put would be worth more money as the market gets lower. So as you're locking in your loss, and after that, no matter what, and no matter how much the market go down to $1, you still can only lose the same amount of money, and it's defined. Just like it's defined with the other ones, the call, whatever the price of the call is, and also the price of the straddle as well. So let's see if we have, we are still spinning on this one. Sorry, folks. I can't get this to, maybe if I reload it. The latency with the laptop is what's screwing us up today. We had some technical difficulties with the mic on the other computer. Okay, so let's see if we can get this back to where we're now. Okay, so ATHM, let's see if we can activate one of these trades here. ATHM. Okay. And we're going to do just the call, the 29 strike. So add an option, action buy to open, expiration. Here we go, folks. We got it. We got it. July. Wasn't that what we wanted? We wanted July expiration. $29 strike price. Hey, okay, we don't have $29. So we'll have to go with, let's see, where were we? We're at 29. So it's 30 or the 28. So we have to adjust for our examples. So, or we have to go with the $25. Okay, so we buy the $25 call. Let's see what it is. Okay, so for the market value of this call right now, it is $670, $670. Okay, so we have to adjust this because the market is wider. Okay, so now this would be a, what was that again? $25. That's below our example. Okay, so sorry about that one, folks. Now we got the latency. Didn't realize how far the screen was on the spread. Okay, so let's go back to PZT. You can see us enter this. Add one, buy to open, and there it is. It's not working again on this one. Okay, we're not gonna dwell on that one again. Just dealing with the technical issues. Okay, so we got the ATHM on. All right, now let's go on to the BANC. This will be good for you folks here who are watching the bank stocks. Okay, we have a short-term double bottom here that occurred in Bank of California. Pretty interesting. We know how the banks have not exactly been in the best of light over the past couple of months, but they're very, very beaten up. In this case, we have a double bottom that has occurred, and we also have a buy signal on the MACD. So let's pull up bank here and see what we pull up here. Options, let's see if we can get some buy to open calls. We got June. Okay, let's see what we got here. So bank is trading here at 11.28. Let's see, for strikes we have 11.28. We have a $10 call. Okay, so let's do this one here. We have $10. Is our strike price for our call. All right. All right, so we have a $10 strike price for the call, and we have a price of $2.20. So to put on this order, we see what the price is here. Total cost $182. Trade is verified. Okay, and now we will go to our account summary, and you can see how the trade is executed. Okay, there we go. Hey, we have some latency catching up here, folks. Maybe they adjusted it while we were doing this. Okay, so here we have this one. We finally have a trade entered here. We have bank. We have the call that is initiated. So once again, fundamentals, we know the banking industry is in a lot of questions, but the Fed seems to be ready to bail out everybody, so it doesn't seem to be too much of a worrisome thing. So on a bullish note here, we have a double bottom, and we also have a buy signal here, which gives us a short-term counter trend trade. So in this reason here, the call is actually a pretty good strike price, because anything, if the market falls below here and this becomes a loser, well, if you own the stock, you would be in a lot of pain also. In fact, you'd be down even more money. So in the short run, if you wanted to start to nibble away at being a bull at the BANC stock, instead of buying the stock, buying a call might be a good thing to do also, because let's say the market does rally up to say $14, $15 between now and expiration. You would have the ability to exercise the call, and you would have only had to put up a small amount of money, which would be, we already said was the $245 price of the option. Okay, so right now we have, or excuse me, $200, just under $200 price of the option. So we have that one in place. Now, for instance, because we know that the banking crisis is going on, we know there's a Fed meeting coming up in 3 weeks. Maybe now, instead of not worrying about direction so much, maybe instead of using the call, even though we have a buy signal, we put on the straddle. Okay, so for this one, we would be doing the $10. Let's go back to here, so trading. And we're going to add another one, buy to open. And we're going to go out to July for this one, give us a little room. And with this one here, we'd use the $10 and the $10. And we put call up here and put up here. And here we go. We have the total price. So we have a buy to open 1 July 23 strike price $10 call. Okay, and we have also a buy to open 1 July $10 strike price put. Okay, so we're buying both of these. So we verify this, and that cost is $309. And now we have a volatility trade instead of just an outright trade. Okay, so we're waiting for that to pull up. Okay, there we go. So now you can see that we have our 2 trades in. We have one outright call, and then we have another call, but it's offset by the put, which makes it our straddle. Okay. Now in this case, because of the pricing of the options and they're so cheap, we wouldn't want to really be looking at any credit spreads, just because of the pricing from where they're at. There's not enough money to take in on a credit to make it worthwhile for the risk, especially. So in this case, it would be buying the call, taking the straddle, which is where you're buying and buying the put and call the same strike price, and you don't care about which way it moves, you just want it to move. Or you could buy the stock. However, in this case, especially considering how beat up the market is and stuff like that, and the banking sector, it would probably behoove you to be nibbling away with options first before getting fully invested on an equity level. Okay, so let me see if I can see if there's any questions out there real quick. Okay, Q&A. All right, I don't know. Can't get that one. Okay, so missing that. Can't see if there's any questions. So I'll have to keep on going with the stocks here. All right, so we have the balances here. Let's go back to our trading screen so that that is ready. And pull that up. And now we'll go on to our next stock. Okay, so now let's do a sell sign. We've been doing all this bull stuff. We know that there's a lot of bears out there, especially with the way the indexes have been moving. So here we have ALDX, Aldera Therapeutics. We have a double top in the market. As you can see, there was a nice trend higher. The market is still above the 50-day moving average and the 200-day moving average. However, it's starting to flatten out on the 50, and obviously the daily trend has been grinding lower for the stock right now. As far as the lagging indicator, the MACD, it's kind of a neutral. It's not oversold, but it's definitely not ready to really say it's a buy signal forming. It's not oversold, it's not overbought. It's just kind of in that neutral choppy zone. Oscillators here are bearish, and this still hasn't come down enough to really warrant it being a bull. Okay, so we don't have anything to really look at the buy signal. So now let's look at the options on this one. So ALDX, let's pull that up. Okay, so ALDX, and we want to get rid of that, and then we want to add an option, buy to open, and with this one now we're looking at sells. So let's see what kind of strike prices we have here available for us from ALDX. So we're going to look for a buy to open, a July expiration, and let's see what was the market trading at. It's trading at just below 10. So a $10 put. Let's see, $1.40. All right, it's a $10 put. Let's mark this on the screen here. And we'll get this trade in. So at $10, we have a double top in the market. I would never suggest anyone, even the most experienced traders, shorting stocks. It's a dangerous game. It's better to use derivatives such as options for doing that. There's so many better ways to handle the short side of the market. Now in this case, the market is trading just a little bit below our $10 strike price put. Okay, and that's what we're going to be purchasing is a put. Remember, a put is the right to sell the market. It's a way of being short. So ALDX, we have a put, a $10 140. We're going to verify, and there we go. And then we go back to our account summary. We now see ALDX now is in on our statement here with the quantity of what's sold, the average price in 140 was our entry. So we have that already available to us. So now in this case, what about a straddle or a strangle? Well, we know that this market has been trading in kind of a range trade. It's topping. If the top is secure, we should still see some good movement. But what if it just decides to all of a sudden bring back the bull trend? Well, then we need something like a straddle here. But however, why don't we look at also the credit spread real quick before we get to that. So let's see, here's a $10 strike price. So 10, there's 12.50. So let's see, what if we were to sell to open this one and then buy to open July 12.50 put. Okay, so let's see, we would be getting 125. Oh, see, this wouldn't be a good credit spread. Okay, so this is where you have to check out your pricing here. Oh, wait, I'm sorry, I'm using the wrong one. It's a call. My bad. There we go. Okay, there we go. There's our credit. So our credit here would only be 50 cents. So that's $50 on this one. For a credit spread, it wouldn't make, the risk is just too high. You would be only getting literally $50 while you're risking $1,000, because you have, or excuse me, you have 250, it's 250, you have 2,500. You wouldn't want to be risking the money on that one. You'd be collecting basically pennies on dollars. So for a credit spread, it's not worth it in this occasion to be playing the bear side of that. Buying a put, on the other hand, that there is good value in. So now let's see, what about for doing the straddle? So if we buy to open, and now we keep this all as we're buying the $10 put. Okay, so now if we bought the that's a different story. So this would cost us $255 for this one here. That would make more sense. This way we get coverage on both the upside and the downside. So what do we do here? We have a put right here at $10, so we're looking for the market to go lower. We looked at the pricing on a credit spread where we would have been selling the $10 and buying the $12.50, but there's too much of a disparity in strike price. You have a $2.50 distance, and the pricing on it is just not worth it whatsoever. So there's no value there whatsoever for you to even think about a credit spread. But if, let's say, the market was to not do what we want to do, let's say all of a sudden the bulls come back and we have a raging market that gets back above, let's say it gets above 12.50, well, our put would be worthless. But what about if we have the straddle? Now we know our straddle, in that case, where we're playing both sides of the market, we have potential. Okay, now to the upside, we know we have that to cover us, but let's see how far we could possibly go with this move. So let's just say we get to 50%. We still have a good chance of getting down another $1.30 to somewhere in this range here. So let's say we get the 50% correction. We're down in this range between 8.30 and 7.82. Now the markets, that would give us a total of $1.50 to upwards of almost $2 of a move to the short side for either the put or for the straddle, both of which would give us a nice profit ratio on those trades. And being the fact that they're not necessarily counter trend trades, because the price action has shown that now the market is in a short-term bear trend to neutral outlook. So we're trading with the double top. It is longer term against the trend, but not in the short term. We're actually going with the trend. And we know that our risk is defined. We go back to our thing here. We know our risk was on the ALD, on the bank, excuse me, on the put. Let's see, where is it? For the ALDX, for the just the regular put, it was $265. Excuse me, $265. And then we also have for the call, we have the $107.50. Okay, so we know exactly what our total risk is. We know exactly where our risk reward, our target is for the downside. And if we get down to this level, we know that we're making $1.50 to $2. So what would that mean? That would mean that on the put value, that would increase by $200 on the individual put. Okay. Now on the straddle, remember that you make money on one, you lose money on the other. However, on a $2 move, you would be making more on the put than you'd be losing on the call, because you would have the volatility factor that would also come in and start to cover it, the profit basis on that. If you only had, say, a 50-cent move or a dollar move, especially come expiration on that in July, then your straddle would be probably worth less than you paid for it. But if you get a move down to here, $2, that's a different story, because then you'd be getting that $2 premium that would absorb it. Remember that the total cost, what the total cost was for that one. Okay, so we have the, let's see, we have the BANC stock that we traded, where we did the outright call, and we also did a straddle. Then we have the ADLX, and let's see, actually we didn't do the straight put, so we cancel this one, and then here we have the straight, and this makes it a little bit easier to see. So we go back to our account summary, and just waiting for that. Okay, so but anyhow, so 140, so $1.40. Remember, we were here trading at 967. So if we get down over here, what's our total distance here? We have, right now we have a $10 strike put, okay, that costs $140. Okay, and if we get to the target, even just say like, let's say we get right in the middle, down to $8. Okay, that would equal 200. Oops, tab on that. 200 in premium. Okay. So for just the individual put, if we come down into this area here, and then we'll get to the straddle next. If we just come down to, say, this area right in here, we know that it's something that costs us 140 will be worth 200 just from the price move alone, plus whatever the time is left on it. So you'll probably be worth around 240, which would give you upwards of a 40% return in just the course of a couple of weeks. I mean, I think it's going to take more than a couple of days for this move to happen, but you would have until July. Remember, we used the, if I remember correctly, we used the July options. We did use the July option. Okay, so that means you have all the way, you have, was it 4, 6, close to 8 weeks of time before you have to worry about it. So I know we had some problems with the computers, but I think that the numbers should start to show you how these things add up, especially when it comes down to figuring out your profit ratio. So remember, we had the credit spread opportunity. We didn't take that one because there was not much credit to take, meaning not much reward, but we knew there was a lot of risk. With our put example here, remember I said shorting a stock is probably not a very good idea, even for experienced traders. There's a whole bunch of nuances on that one. But buying a put, for instance, that is a great way to play the bearish side of the market. Now in this case, a put that costs $140, you have 8 weeks of time to catch this move, in which case you're going to most likely make around, unless it was, let's say it goes down to $8 and it took all the way till expiration, you're still making at least $60+ on the option. Okay, because it's a little bit more because the market is at 967. We have 40 cents of premium into it, so that would be it. You'd have $240. If you have a $200 move, you would have 240 at expiration. So that would be, once again, just over 40% anytime between then. Now, if you, let's say it happened within the next 3 or 4 weeks and we got down to $8 and you still have 4 weeks left to go, well, then you still have a little bit of time premium, not much left. So you probably make a little bit more. And I would say in that case, if you were to initiate a put in this situation, you would want to get out of it once you hit that profit target, because even though the market could go lower, if you made 40%, say in a week and a half, 2 weeks, I don't know about you, but that sounds like a pretty good return to me, especially on a risk level such as that. And on the straddle as well, if you get down for that $2 move, the same thing would occur as well. Now, would you make as much? Would you make a 40% return like you would on the put? Of course not. That would be a little bit less. The reason for that being is because as you're making money on that put going down, you are losing money on the call, but there still would be time value and some value, some premium for some of the other Greeks that we're not going to get into in this webinar. So that's where your money lies on that trade right there. Now let's see, we can look at, I think we have time for one last one. Let's do one that you probably know. Let's see, HGV. Let's see what that looks like. HGV. What was that? That was a reverse head and shoulders. Okay. Yeah, here we go. Okay, so for really quick here, here's an S. Here's a head. And here's a shoulder. So for those of you who are familiar with classical bar charting, here's a head and shoulders pattern. As you can see, the market made this low here. It rallied back up. It came down. It made this lower low here. It came back here. And then it came here and made a higher move low. That's when all of a sudden this level here becomes very important. Okay. There's a neckline. Because this low is here, it's a little bit higher. Usually it's on an angle. But this right here shows us that we have a breakout. It's called a reverse head and shoulders. When you have that, does it mean that the whole trend is going to reverse? No, it means that in the short run, odds are that the trend going lower has come to a close for a little bit. It could mean just a neutral to positive trade. So in this case, let's look at HGV. This is a great example for a straddle. Okay, we're going to do a buy to open. We're going to do a buy to open. Let's see, HGV is traveling right around $45. Let's see what the strike prices are. Let's go to July. We're going to do strike price of 45. There we go. Perfect. Call and a put. So we have $485. Okay. All right. So right now, do we have a buy signal? No, we got kind of mixed emotions here on the lagging indicators. Excuse me. We are slightly above the moving averages, but they're pretty flat. So we have the buy signal, very neutral trade for Hilton Garden Vacations. We all hear about how travel industry right now is booming, and we are coming into summertime. So potential for a bullish breakout definitely exists. Slowing down in the economy, high inflation, what have you, could that put a damper on travel and leisure? Very possible. If you're a bear, then that would mean that we have a good chance of coming back to these lows sometime in the not too distant future. But I think because we're coming in the summertime, we have a better chance of probably pushing up towards this $48, $49 area. So let's see what we got here. We have this down to here. Look at where we are. This is key. Okay, so this is good. So we have a potential breakout area here. This swing high here is just below our 50% level. And let's put this up. We're at the top of the circle here. This is the 0.618 area. So if this market is done rallying, we've hit a critical area of resistance. So buying a call, definitely not a good idea. Buying a put, we really don't have a solid reason to sell it. So now we put the straddle on. This is where we use the $45 strike price because that's just above where the market is at right now. So we have buy to open July 23, strike price 45 call, and the same thing as buy to open July 23, 45 strike price put. We verify it, we put the trade on, and there we go. We go back to our account summary, and we can see that we have HGV right in here with the market value of the puts and the calls. Okay, so we know we paid $450 on that one. What kind of a move are we looking for? Well, we're looking for every bit of a $4 move. We're looking for it to go from 44 up to 88, somewhere up in this consolidation area. If we have a nice trend because of summertime, and if the pundits are right, that travel and leisure truly is booming, we have a good trade there. And if the market drags it down like everything else and we go to test these lows, our straddle's in a good way. So a $4 move within a month and a half, very good risk reward potential there because of what's going on here. Even if it stays in a range trade, it's very likely to hit the upper or lower extreme sometime within the next month and a half, definitely 2 months, which gives us with the July expiration. So, all right, so let's check our account summary. And so as you can see, all the trades that we entered are here. And I want to thank all of you for your time today with us. And I am going to now turn the mic over to Gina.
Okay, great. Well, thank you so much, Teddy. We really appreciate you taking the time to speak to all of us today. And thank you to all of our attendees for joining us. Just a few reminders before we go. If you'd like a recording of this webinar, we encourage you to subscribe to eOptions YouTube channel. And as soon as this is available, most likely tomorrow, you'll be notified. And I did put in the chat box a direct link to the YouTube channel. So if you just want to take a moment and go to the chat box, you'll see that. And you can just click on that and hit subscribe. You'll be notified as soon as this is available, as well as any other new videos that we have available. And we do new content all the time with professional traders, as well as our trade desk. So we encourage you to check it out. It's a really valuable resource. And a few folks had questions in the Q&A box. I just went ahead and answered. One of them was international accounts. We do allow accounts throughout the world, but we do have a list of approved countries, and you'll also find that on our website at eoption.com if anyone would like to learn more. And we're always here at eOption to help you with your trading. So if you have any questions at all about an option strategy, maybe that Teddy talked about, or how to use our trading platform, or how to set something up on our trading platform, we're always here to help you. We have a great trade desk team and customer service support team that's very helpful. So you can always send us a question at support@eoption.com, or give our trading desk a call, and we're happy to be there for you. And just one more thing I wanted to point out is that we know we have clients as well as some of you are not existing clients. So if you are interested in opening an account with eOption, we do have a free stock promotion that's going on, and you will find that once we have this up on our YouTube channel. If you just go in the description box, you will find that. You could just click on it and find out more details. So that's a little bonus you get for attending the webinar that you find out about. And so with that, thank you for your time. Everyone at eOption greatly appreciates it. And be on the lookout. We will have more webinars in the near future. So we'll be notifying everyone who is attending this webinar of future ones that we have. So thank you again. And we hope that you have a wonderful holiday Memorial Day weekend. Bye now.